Well, the Fed's decision to cut that benchmark interest rate has far-reaching consequences, not just in the United States, but across the globe. Worldwide, the Fed's decision to loosen its purse strings could encourage other economies to do the same thing. Reuters reports it has tracked about 9 emerging economies already cutting rates this cycle. However, experts say institutions such as the European Central Bank and the Bank of England will be more cautious with fewer plans for more cuts ahead. The Fed's rate will also have an impact on foreign exchange rates as the world's principal reserve currency, the U.S. dollar, has a huge impact on the cost of borrowing for emerging markets. Now, a weakened dollar could lift other currencies, with the yen and Swiss franc expected to see some relief through 2025. Now, for a deeper dive into all of this and how the Fed's decision is going to impact economies all over the world, let's bring in our friend Thomas Hayes. He's the founder, chairman, and managing member of Great Hill Capital, a long-short equity manager based in New York City. Thomas, great to have you back on. I find this pretty fascinating. Let's, broadly speaking, kind of walk us through how you see the Fed Reserve's rate cut influencing the global economy.
Well, Sean, thanks for having me on. I think the number one thing that happened with the 50 basis point cut and front loading that cut to a large size is it took a hard landing off the table. What we saw as the immediate response as it relates to bonds was a buy the rumor, sell the news. So while everyone said, well, rates are going down now 50 basis points, why did yields go up in the last few trading sessions following that 50 basis point cut? And that's because a lot of it was priced in ahead of the cut. But I do think that is a counter-trend move higher in yields in the short term over the next couple of weeks, counter-trend move higher in the U.S. dollar, short term over the next few weeks. But I think as you look at the intermediate term and the continued cuts and the continued reduction of restriction, you're going to see a weakening of the dollar. You're going to see rates come down, and that bodes extremely well for emerging markets equities.
Let's talk a bit more about the impact on these emerging markets, because emerging markets borrow money. And if the interest rate is going to be reduced, it seems it is going to ease the burden on nations borrowing these funds.
Yeah, there's no question. What you see in periods like this of easing cycle for the Fed is emerging market equities tend to outperform developed market equities. In the U.S., small caps tend to outperform large caps by 11% in the first 12 months. Value stocks outperform growth, and consumer discretionary comes back and outperforms consumer staples. We've seen a huge crowding into consumer staples and utilities, i.e. defensive stocks, ahead of the cut. And now that we have cut, the 50 basis point cut, I think it's reset growth expectations. If a hard landing is off the table, we could see higher than expected growth coming forward, and that shifts the type of stocks you want to be in.
Now, let's think back to that Friday when the rate cut came, because the markets really didn't do much that day, but they have rallied in the coming days after that. So let's talk about the impact of the strength of the U.S. dollar and global trade balances. And I'm curious about the effect you think that the U.S. Central Bank cut is going to have on China, if any.
Well, historically, Chinese equities is a large weight in the emerging market equities index, and we believe that Chinese equities will start to outperform. It is going to need some help from the Chinese government itself in terms of a larger, more aggressive stimulus, but the table is set. If the Chinese government moves to stimulate, you are going to see a dramatic outperformance of Chinese equities over U.S. equities in the next 1 to 3 years. If they fail to do that and they start to miss their growth targets, it may be a more subdued response and a missed opportunity of a lifetime for the Chinese government and the Chinese people.
Interesting. Okay, how do interest rate cuts impact international capital flows, especially in sectors like real estate and technology? To a certain degree, as the global markets are pushing for the soft landing you've been talking about, nations tend to play follow the leader. Now, we know that the Eurozone and the Bank of England, they made cuts ahead of time. So the other nations, these emerging nations, they're going to be rising rates to curtail inflation to try to stimulate growth.
Money goes where it's treated best. So on balance, money's going to flow into those places that have higher yields. That's going to strengthen some of the emerging markets currencies. I also believe a lot of currencies relative to the US dollar, whether it's the Canadian dollar, the British pound, the euro, emerging market currencies over time. And the big story that we have to keep our eye on is the yen, because while we've had about 85, 90 cuts around the world year to date, the Bank of Japan is looking to start to curb inflation. And they started with a hike in August. We saw the result of that in the first week of August, a big correction. Then they said, oh, we were just kidding. We're not going to do that so much anymore. Certainly not until the Fed got easy, which they just did. So I think before the end of the year, we could see more tightening by the Bank of Japan, which is a stronger yen against the dollar, and maybe more subdued response in Japanese equities than we've seen in recent years.
I like the just kidding. Okay, with inflation cooling down, do you think this rate cut is going to reignite inflationary pressures in other parts of the world? You talked a bit about what happened in Japan.
Japan is not affected. Their inflation is affected by many, many, many years of very easy policy by the Bank of Japan. So that won't be impacted as much by the U.S. policy. I do think that U.S. inflation should hover closer to a mean of 3% over the next few years versus a mean of 2%, i.e. the Fed target. And that's probably a good thing. When you have debt to GDP at 120%, historically, like we saw post-World War II, if you run inflation a little hotter than normal, it's easier to bring those debt to GDP ratios down than if you start to get closer to deflation, then the debt problem could be a bigger issue. So I think 3%, 3.5% is the sweet spot, and that's probably the base case for the next few years.
Quickly, Thomas, not a lot of time left here, but I'm curious if you think that the Fed waited too long to cut interest rates, because there was that concern if they cut 50 basis points, then they waited too long, and the markets were going to have an adverse reaction that first day when not a whole lot happened. I think people were tense.
They waited too long, and they're going to get away with it. So I'll leave it at that. I think that the front load was positive. We're going to see in the jobs report, not this Friday, but the Friday after, and then that will determine how quickly they have to catch up. Look, they were behind the curve on inflation, but they caught up. Let's hope that they can catch up in time, and I think they will, in fact, pull off the soft to no landing by moving as aggressively and as quickly as they did.
Well, I think a lot of investors are hoping you're exactly right. Thomas, thank you so much. We appreciate it.
Thank you, Sean.
Okay.